Let's see what a margin call looks like for a short position. And now this is very important. A short margin call happens when I lose money in a short position, which means the stock price must go up for me to lose money. And so when we're done and if we've calculated this and the stock price has gone down, we screwed up. It must be the case that the stock price goes up for us to lose money and therefore have to put in more margin. So again, we're going to deposit $80 in a brokerage account and sell short $100 worth of stock. And so the cash from the short sale is the 100. We put up $80. Our total assets is 180. The value of the stock that's owed, we owe one share valued at $100. So we owe $100, and the equity is the 180 minus the 100 is the $80. The short position margin rate is again the equity value, the equity divided by the value of the stock owed, and so that's 80%. So the new question is, how high can the stock price go before the margin rate again gets to 30%? That's the magic number. And so, again, doing a bunch of algebra, the margin rate equals the equity divided by the value of the stock owed. Equity is assets minus, well, shares times P, that's the liability, divided by shares times P. And so we want to solve for P and then plug in all our values. And so here's the formula. The short margin call price, P, is equal to total assets divided by shares times 1 plus the margin rate. The total assets is the 180 divided by 1 times 1 plus 0.30. Be careful when you're doing these computations. Order of operations, parentheses matter. You have to multiply the number of shares times 1 plus the margin rate, and then that all is 180 is divided by that whole quantity. And so I get 138.46. And let me think, the price was $100. It's now 138.46. The price went up. Let's check and to make sure this works. So on the asset side, nothing has changed. I still have the 100 cash from the short sale. I still have the $80 margin cash, and so total assets is 180. But now the value of the stock owed has gone from 100 to 138.46, and so my equity is the assets minus the liabilities, the 180 minus the 138.46, and that's the 41.54. And so now my short position margin rate is the equity divided by the value of what I owe, the 41.54 divided by the 138.46, it's 30%. And so we got it right. So let's see what happens if the price goes even higher to 150. If the price goes to 150, then again my assets haven't changed. I still have 100 cash and 80 cash, so that's 180. But the value of what I owe is now 150. The equity is 180 minus the 150 is $30. And so now I can calculate these three things. I can figure out the return of the stock. The stock went up by 50%. The equity went from 80 down to 30, so I lost 62.5%. And again, those ratios hold. The stock return divided by the equity return is equal to the negative of the margin rate. And the equity return divided by the stock return, the inverse is the leverage ratio, negative because I'm short. And then finally, my new short position margin rate, same formula, equity, which is the 30, divided by the shares times P. And remember, still dealing with one share, so that makes it easy. 150, and now I have a 20% margin rate that is less than the 30%. And so now I'm going to have a margin call. And remember, a margin call is when the stockbroker calls cash from the account holder in order to increase the margin rate. And let's see what the mechanics look like. So again, the 20% margin is below this 30% number, which is the margin call. And so the investor must add enough cash to the account such that the resulting margin is 50%. And margin cash is added, which increases equity. So let's figure out how much cash needs to be added to the account to bring the margin rate back to 50%. And we can look pretty quickly. We know that the margin rate is going to equal the equity divided by the value of the stock owed, right? The equity divided by the value of the stock owed, which in this case is the 30 divided by the 150. I know that I'm going to have to add enough cash so that this is back to 50%. And the way that's going to happen is that this is going to have to be 75, I'm going to have to add $45. Now, this one I can do in my head because it's relatively simple, but usually we're going to have an example that's more complicated than that. But I know that that's what I'm going to end up having to calculate. So let's calculate the dollar amount of the margin call so that the resulting margin rate is equal to 50%. Remember, the margin rate is going to equal the equity divided by the value of the stocks owed. We're going to do a bunch of goofy algebra here to get the margin call account. Total assets minus the value of the stock owed, that's equity. The margin rate times the value of the stock. We're going to do a bunch of substitutions, and I'm going to end up with this idea that the total assets needs to be 2 1/4. So the margin call amount is going to be 2 1/4 minus 180. I'm going to have to add $45. And so the idea is that the margin cash before was $80, but now I need to add another $45. So the cash from the short sale is $100. The margin cash is now 1 1/4. It was just $80, but I was required to add another $45. And so now the total assets is 2 1/4. The value of what I owe is $150. The equity is the 2 1/4 minus the 150 is the 75. That is my new margin rate. And I can see that I had to add $45. And we'll go through this formal process because when it becomes more complicated, it's important that we have a formula and something that we can follow. So what happens if we don't add the cash? The broker closes the position. The broker buys stock from the market at $150 and delivers it to the entity from whom we borrowed the stock, and the position is closed. If the margin call is not satisfied.